What the latest U.S. jobs report really means for the market. Today, we're taking a deep look at the latest U.S. non-farm payrolls report and what it truly signals for the stock market, the economy, and your financial decisions moving forward. Because this month's numbers brought a mix of warning signs, opportunities, and big clues about where the market is heading next. Number one, the headline numbers and why they matter. The most recent non-farm payrolls report showed that the U.S. economy added fewer jobs than many expected. Job creation has slowed to a modest pace, and the unemployment rate has inched higher. Even though the U.S. is still adding jobs, the trend is clear. The labor market is cooling, not crashing, but slowing more noticeably than before. Wage growth also came in soft, rising only about 0.2% for the month. That's not enough to signal strong consumer momentum, but also not enough to fuel inflation. And on top of that, previous months were revised downward, which means the labor market was weaker than we thought. This combination, weak hiring, modest wages, and downward revisions, often sends a strong macro message. The economy is losing steam. But here's the twist. Number two, why a weak jobs report can be good news for investors. A softer labor market doesn't automatically mean bad news for the stock market. In fact, Wall Street often reacts the opposite way, at least in the short term. Why? Because when job growth slows, Federal Reserve becomes less likely to raise interest rates, inflation pressure softens, borrowing becomes cheaper, tech and growth stocks look more attractive. So while the real economy feels weaker, the financial markets may interpret this as an opportunity. This is why sometimes the weaker the data looks on paper, the stronger stocks behave in the short run. 3. What the Fed will likely do next. The Federal Reserve watches the labor market closely. Slower job growth sends a message. Inflation may not rise as fast, so we don't need to raise rates aggressively. This jobs report supports the idea that rate hikes are probably behind us. The next move, later down the road, could be a rate cut. The Fed is likely shifting into a wait-and-see mode. Lower rate pressure is bullish for growth stocks, AI and tech, real estate, risk assets in general. But remember, a weak job market also means slower spending and lower consumer confidence. That's a long-term risk. 4. How stocks might react. In the short term, the stock market could see relief rallies, strength in tech, lower bond yields, weakness in the US dollar, opportunities in gold and commodities. But in the medium term, a cooling labor market poses risks. Companies may lower earnings forecasts, consumer-facing businesses might struggle, housing demand may slow, risk appetite may shrink if unemployment rises too quickly. So the market reaction depends on whether Wall Street focuses on the Fed relief or the real economy slowdown. Right now, traders are leaning toward the first one. Less Fed pressure, more liquidity, more risk-on behavior. Number 5, how this affects real estate, mortgages, and everyday Americans. For the housing and mortgage industry, which you specialize in, the data has very real implications. Housing demand may soften. A weaker labor market means fewer people feel confident to buy homes. Affordability becomes more important. Slower wage growth plus job uncertainty means buyers become more cautious. Interest rate expectations may shift. If the market believes the Fed is done hiking, mortgage rates may stabilize or even trend downward, which can help affordability. Refinancing may increase again. If rates drop, homeowners may return to the refinance market. For everyday consumers, job security worries may rise. Spending habits may tighten. Borrowing may slow. Savings rates may increase. This is where financial planning becomes essential and where your content provides tremendous value to your audience. Number 6, sector by sector breakdown, simplified. Technology, likely to benefit first from lower rate pressure. AI companies, software, and high-growth names may strengthen. Consumer spending could weaken as wages flatten and job growth slows. Real estate, demand cools, but financing becomes easier if rates flatten or fall. Good for buyers, challenging for sellers. Financials, banks may become more conservative. Mortgage brokers may see mixed conditions. Less volume, but more refinancing opportunities. Commodities and dollar. Dollar may weaken from lower rates. Gold may rise. Oil becomes volatile. Number 7, what this means for investors. Right now, this environment requires a balanced strategy. Here are smart approaches. 1, lean toward high-quality assets. Companies with strong balance sheets will outperform in a slow jobs environment. 2, watch bond yields. If yields fall, growth stocks and real estate benefit immediately. 3, look for buying opportunities in weakness. Soft payrolls sometimes create temporary dips. Opportunities for long-term investors. 4, protect against volatility. As unemployment rises, volatility follows. Keep stop losses tight. 5, stay flexible. This is not a crash now economy. It's a slow fade economy. Conditions can change quickly. Number 8, the big picture. Soft landing or early warning. This jobs report doesn't scream recession, but it does whisper, be careful. The U.S. economy is slowing, even if it's not collapsing. The labor market is still functioning, but momentum is fading. The Fed is likely shifting to a less aggressive stance, which might boost markets temporarily. But the undercurrent is clear. Consumers are getting weaker. Companies are slowing hiring. Wage growth is soft. Previous hiring was overestimated. There is less fuel for future economic growth. This is the kind of environment where markets can go up, even while the economy slows down. That's why traders, investors, real estate professionals, and homeowners must pay close attention. Number 9, final thoughts. This non-farm payrolls report is a reminder that the economy is cooling. The Fed is watching closely. Markets are reacting to interest rate expectations more than economic strength. A soft landing is still possible, but not guaranteed. If you're an investor, homeowner, or market watcher, this is the time to stay informed, stay patient, and stay flexible. Number 10, closing. So the big question now is, will the market continue to rise on hopes of lower interest rates? Or will the weakening labor market eventually pull stocks back down? We will dive deeper into the market and give you an answer very soon. So please don't forget to like and subscribe to the MMS channel to make sure you never miss any breaking news or updates from us. Thanks for watching.